Every expert said it was inevitable, the crash that would finally bring Wall Street to its knees. The numbers were clear: record debt, inflated valuations, collapsing productivity, and a public running on credit instead of income. Every signal pointed down. But the market refused to fall. Stocks kept rising, confidence returned, and economists once again declared the system resilient. But what if the market didn't survive by luck? What if it survived by design? Because behind the glowing screens, behind the optimism and headlines, there's a machine, a financial architecture built not to create prosperity, but to maintain control. It doesn't care about growth, innovation, or fairness. Its only purpose is to keep the illusion alive long enough for those at the top to cash out before the fall. The Federal Reserve, the megabanks, the high-frequency traders, they all know how fragile the system really is. But fragility isn't failure, it's opportunity, if you know how to manage it. The market isn't defying gravity, it's being held up by strings. Monetary manipulation, algorithmic trading, and carefully timed interventions. It will collapse, but only when it's useful to collapse. Because the modern stock market doesn't react to reality anymore. It reacts to power. And that's the hidden reason it's still standing. Most people still believe Wall Street is a marketplace, a chaotic but fair arena where investors take risks, companies raise capital, and innovation drives value. But that version of the market died years ago. What remains today is a machine, engineered not for competition, but for control. At the center of this machine sits the Federal Reserve, the Treasury Department, and the world's largest megabanks. Institutions so interconnected that they no longer compete. They coordinate. Their real product isn't innovation or growth. It's stability theater. The appearance of a healthy economy built on the quiet manipulation of money itself. The primary tool is something called quantitative easing, or QE. It sounds technical, but its purpose is simple: create money out of nothing and use it to buy financial assets. Every time the Fed announces it will purchase $50 billion, $100 billion, or $1 trillion in bonds, the banks act first. They buy those same bonds, knowing the Fed will pay more for them later. When they sell back, their profits are guaranteed. If private traders coordinated like this, it would be insider trading. When the Fed and banks do it, it's called monetary policy. That newly printed money doesn't go to small businesses or workers. It flows directly into the financial system, inflating the prices of stocks, real estate, and commodities. The top 5% of Americans, who already own over 60% of all financial assets, grow exponentially wealthier. Everyone else faces the aftershock: higher prices, stagnant wages, and a shrinking future. QE doesn't create wealth, it concentrates it. The result is an economy that looks prosperous on paper, but feels broken in real life, because all the growth lives inside the balance sheets of the elite. This is not a malfunction, it's a design. Every major market movement, every rally, every miraculous recovery is orchestrated by the same forces pulling the same levers. They don't need the market to be strong, they just need it to look strong. The illusion of confidence keeps capital flowing upward while the real economy quietly erodes underneath. What most people call market resilience is simply monetary engineering, the controlled suspension of gravity. But like any illusion, it only lasts as long as the audience believes it's real. And when that belief starts to fade, the system has a plan for that too. A perfectly timed illusion of prosperity that keeps the crowd cheering even as the floor beneath them starts to crack. Every empire masters one thing before it falls: the illusion of prosperity. And no one has done it better than the modern financial system. The economy looks alive because money keeps moving, but it isn't moving evenly. It's flowing upward, pulled toward the same small circle that controls the flow itself. The secret is simple: punish saving, reward debt. For decades, low interest rates have made borrowing the only rational choice. If you save, your money loses value to inflation. If you borrow, the system rewards you with cheap credit, tax loopholes, and asset appreciation. It's a rigged equation, and it's working exactly as intended. The result is a society where wealth no longer comes from work. It comes from leverage. Those with assets can borrow against them to buy more, compounding their advantage infinitely. Meanwhile, ordinary families drown under mortgages, student loans, and credit card debt just to maintain the illusion of a middle-class life. Every financial cycle reinforces the divide. When markets rise, the rich get richer. When they fall, the poor lose everything, and the rich buy the ashes. The crash isn't a catastrophe to them, it's a clearance sale. Look back at 2020, the so-called year of chaos. The economy shut down, millions lost their jobs, 400,000 small businesses vanished forever. And yet, by the end of that same year, the stock market hit record highs. How? Because the Federal Reserve printed over $3 trillion, and that money didn't go to Main Street, it went straight to Wall Street. By December 2020, billionaires had gained over $1 trillion in combined wealth. Tech giants doubled their valuations. The same corporations that laid off workers were rewarded with soaring share prices. It wasn't a recovery, it was a redistribution, a transfer of power wrapped in optimism and press releases. The illusion works because it's emotional. Rising stock prices make people feel safe. It tells them the system is working, even when their grocery bills double. It convinces them that if they just stay invested, they'll be fine, even as their purchasing power evaporates in real time. The S&P 500 is no longer a reflection of the economy. It's a reflection of liquidity, of how much artificial money the system can pump in before reality pushes back. This isn't capitalism, it's theater, a performance designed to keep the public believing while insiders prepare for the next reset. Every policy, every headline, every recovery is part of the same act: inflate, extract, and reset. Prosperity today isn't measured in production or progress. It's measured in how long people can be convinced that numbers on a screen equal wealth. But illusions don't last forever. Eventually, the audience notices the cracks, and when they do, the curtain falls fast. Every system of control needs a perfect mechanism, one that looks invisible, objective, and efficient. On Wall Street, that mechanism is automation. The stock market today is not run by people, it's run by machines, executing billions of transactions per day, guided by algorithms that react faster than any human ever could. At least 70% of all market trades are now executed by high-frequency trading algorithms, programs designed not to invest, but to exploit milliseconds of advantage. These algorithms don't look for innovation or value. They look for weakness, a delayed order, a predictable pattern, a human mistake, and extract profit from it in the blink of an eye. This is the new invisible hand, the hand of code. Then there are the dark pools, private exchanges where institutions trade massive volumes of stocks away from public view. There are over 50 of them operating quietly inside the US financial system. Here, price discovery, the process that should happen in open markets, is replaced by private negotiation. Big banks and hedge funds can buy and sell millions of shares without ever revealing the true price. To the public, the market appears calm, stable, and liquid. But behind the curtain, trades are happening in shadows, setting the direction of entire sectors without a single retail investor seeing it. These dark pools and algorithms have created a two-tiered system. The public plays a visible game with delayed information, while the insiders operate in real time. When you buy a stock, your order doesn't go straight to the market. It goes through a network that analyzes your behavior, predicts your next move, and adjusts prices accordingly. You are not trading, you are being traded. The illusion of fairness is what keeps people playing. Retail investors think they have access to the same tools and data as professionals. They don't. Every free trading app is another layer of surveillance, another input feeding the algorithmic machine that profits from your decisions before you even make them. And when the time comes for the next correction, these same systems will amplify it. Algorithms don't panic, they accelerate. When prices start to fall, they sell faster than humans ever could, triggering cascading losses that wipe out months of growth in hours. This is the new face of control, a market so complex that even regulators don't understand it, and so automated that no one can stop it. It's not manipulation in the traditional sense, it's structural manipulation. What makes it perfect is its design. It doesn't require conspiracy, only incentive. Every participant acts rationally for their own profit, but together, they create a self-reinforcing machine that always feeds upward, toward those who own the algorithms, the data, and the access. The market still looks human, screens, charts, and headlines, but its soul has been replaced by code. And that code answers to no one. The deeper you look, the clearer it becomes. The market doesn't move by chance, it moves by coordination. What the Federal Reserve, the US Treasury, the megabanks, and the regulatory agencies call policy alignment is really a carefully orchestrated dance designed to manage perception, not performance. When Silicon Valley Bank collapsed in March 2023, it should have triggered a broader panic. Billions in uninsured deposits vanished overnight. In a real market, investors would have fled to safety, small banks would have failed, and credit markets would have frozen. Instead, within 48 hours, the US government guaranteed every single deposit, even those far above the legal insurance limit. The move was framed as protecting small businesses. But the truth was simpler. They were protecting the network. Because Silicon Valley Bank wasn't just a regional lender, it was the beating heart of venture capital, tech startups, and political donors, a pipeline connecting private money to public power. Its failure would have exposed how fragile that network really is. So the system rewrote the rules overnight. Smaller banks collapse quietly all the time, and no one steps in. But when the interconnected face risk, the rules change. Losses are socialized, consequences are privatized. It's not a bug, it's a feature. This pattern repeats every cycle. The 2008 crisis created the phrase, "too big to fail." The 2020 pandemic refined it into policy. Every intervention since has reinforced one message. If you're part of the network, you can't lose. And if you're not, you're expendable. Even market regulators are part of the structure. The SEC, FDIC, and Treasury Department are filled with former executives from the very institutions they're supposed to oversee. It's a revolving door that ensures no real accountability, only continuity. They call it expertise. In reality, it's self-preservation. When insiders talk about stability, they don't mean preventing collapse. They mean controlling it. The system no longer fears crashes, it uses them. Every downturn becomes a tool to reshuffle ownership, eliminate weak players, and consolidate more power into fewer hands. Each crisis is followed by the same script: panic, bailout, consolidation, normalization. The public sees a rescue. Insiders see an upgrade. That's the genius of the coordination network. It doesn't need conspiracy. It only needs cooperation, a shared understanding that preserving the illusion is more profitable than facing the truth. And when the cracks in that illusion widen too far to hide, the network doesn't collapse, it resets. Because in this system, every failure is simply a new form of control. Every so often, the machine needs to release pressure, not to break, but to breathe. These aren't accidents, they're controlled demolitions, designed to look like chaos while quietly achieving precision outcomes. The dot-com bust, the 2008 crash, the 2020 pandemic collapse, each one followed the same choreography: inflate, implode, consolidate, repeat. To the public, it feels like disaster. To insiders, it's strategy. When the system becomes overextended, the people who built it don't try to save it, they redirect it. They allow selective failures to purge risk from the bottom while protecting the top. The market crashes, but only for those without protection. Hedge funds, private equity, and global banks emerge stronger each time, buying assets at fire sale prices using liquidity created by the very crises they caused. It's not destruction, it's restructuring. Look at 2008. The collapse wiped out homeowners, small investors, and entire pension funds. But it also gave birth to BlackRock, Vanguard, and State Street as the most powerful financial entities in history. The crash didn't reduce concentration, it accelerated it. In 2020, the pattern evolved. The pandemic was sold as an unforeseeable event, but the response was perfectly choreographed. While millions of small businesses shut their doors, the world's largest corporations were declared essential and rewarded with historic bailouts. Amazon, Apple, and Microsoft expanded their dominance as the rest of the economy flatlined. Every crisis removes competitors. Every rescue strengthens control. And when it's time to tighten again, the same system engineers a downturn to clean the slate. Quantitative tightening, rate hikes, and regulatory crackdowns follow, framed as responsibility and discipline. But it's never about fixing the system. It's about timing the reset to maximize consolidation. Even the crashes are monetized. Hedge funds short the markets they helped inflate. Central banks print new liquidity to buy the assets that fall. Retail investors lose faith, sell at the bottom, and their wealth flows upward once again. This is the pattern of managed capitalism, a perpetual motion machine of boom and bust, where nothing happens without purpose. The narrative changes, but the function stays the same. Cleanse, consolidate, continue. And when the next unexpected collapse arrives, remember, the system doesn't fear crashes, it requires them. Because every collapse isn't the end of the cycle, it's the maintenance of it. At some point, every illusion meets gravity. The system can manipulate data, control liquidity, and engineer sentiment, but it can't manufacture trust forever. And that's where the real collapse begins. Not in the numbers, not in the markets, but in the minds of the people who once believed in them. The true endgame isn't financial, it's psychological. When confidence dies, no policy can revive it. When people realize that prices don't reflect value, that profits don't reward work, and that markets are designed to deceive, the spell breaks. The charts can still rise, but belief doesn't. That's the moment every empire fears, when its citizens stop believing in the story. Because money, at its core, is just a story, a shared fiction backed by faith. And when that faith erodes, every printed dollar, every bailout, every intervention becomes meaningless. We've already seen the early cracks: inflation that refuses to vanish, national debts that can never be repaid, currencies losing credibility faster than they can be defended. The powerful will call it a transition, a restructuring, or even a digital opportunity. But beneath the slogans, it's the same truth whispered through history. The system is eating itself. The end won't come with an explosion. It will come with a silence. The quiet realization that the wealth, the stability, and the progress people trusted were never real to begin with. And when that silence spreads, the same hands that built the illusion will start building the next one. New systems, new currencies, new promises. Because collapse isn't the end, it's the reboot. The markets will rise again, headlines will call it a recovery, and the cycle will reset until the next time belief runs out. Because the stock market doesn't measure value anymore. It measures how much faith people still have in the lie. In the end, the market was never meant to be fair. It was meant to be believable. Every chart, every headline, every televised victory of record highs exists for one purpose: to sustain confidence long enough for the next transition to begin. The illusion of prosperity isn't a side effect. It's the product, the performance, the only thing keeping the system alive. But illusions have a cost, and sooner or later, someone has to pay it. When that time comes, it won't look like panic. It will look like normal life, until the numbers stop adding up, until banks quietly tighten credit, until people realize the system hasn't been protecting them, it's been using them. Because the greatest deception isn't that the market is rigged, it's that it ever reflected reality at all. And when the next miracle recovery comes, when the screens glow green again and analysts call it a comeback, remember this: Nothing real needs constant saving. The market will stand until it's no longer profitable to hold it up. And when it finally falls, the truth will sound familiar. It was never built to last. Fade to black.